Hello, my name is Tim Congdon. I'm chair of the Institute of International Monetary Research at the University of Buckingham. It's late June 2024, and this is another in the series of videos that I prepare about monetary policy and theory and applying my ideas to the world economy. In the last 4 years, since the outbreak of COVID in late 2019 and early 2020, we've had an increase in inflation, and then more recently, the last year or two, a drop in inflation. And one of the most important debates about this period is why inflation increased. Now, in spring 2020, in fact, my first warnings went out in late March and early April, I identified an explosion in money growth and warned that an inflation flare-up was likely in the next 18 months, 2 years. And that warning was correct. And this was an application of the quantity theory of money. One of the strange features of what happened at that time was that I was almost alone. I had one or two colleagues helping me who were saying similar things, but I was almost alone. And the great majority of economists, professional economists, were wrong. They expected COVID to lead to a disinflation, even deflation, and for these effects to extend out into 2025 and 2026. And one of the objectives of a publication that I've just completed, just been published by the Institute of Economic Affairs in London, is to discuss these events. I set out my view about why inflation increased, and indeed the appendix to this short book has a reprint of one of those special emails in late March 2020, just showing how I correctly diagnosed the problem. But what I also want to do is to try and understand why the profession as a whole was so wrong. And this is something that plainly is very important to the wider public debate on economics and macroeconomic policy. Last month, I think there are in this pamphlet, in this short book, I protest about two kinds of economists. I protest about people who are concerned about money, but focus on the monetary base or narrow money. And then I'm worried about economists who don't look at money at all. And in particular, they espouse what I call interest rate only macroeconomics, of which a notable example is the three-equation new Keynesianism, which has dominated central bank research in the early 21st century. Now, last month, I focused particularly on this debate between myself, if you like, a broad money monetarist, and the narrow money monetarists and the monetary-based monetarists. And I said essentially that the monetary-based monetarists were wrong, done a lot of damage through bad forecasting. Much of the ideas did come from the Chicago School, which was where they were led by Milton Friedman. And I propose that, quite frankly, Chicago School monetarism is dead. And I don't think that that's controversial. I've had nobody coming back to me and saying that I've been overstating all this. So that's one aspect of this debate. We must look at the correct measure of money, and we need to have a persuasive account of how that money interacts with the economy, which is what I've tried to do in my career and in this short book I've just published. But then there's also the much larger number of economists who don't look at money at all. They have been particularly prominent in the 21st century. I think to try and get a sense of what I'm protesting about, what I'm against, we should notice that there were two key contributions just at the turn of the century. There was a contribution from Richard Clarida, Jordi Gali, and Mark Gertler in the 1999 Journal of Economic Literature, an article on the science of monetary policy, a new Keynesian perspective. And then there was a book just 4 years later by a chap called Michael Woodford, the title Interest and Prices. And the article didn't include a banking system. The 1999 article didn't include a banking system or any reference to the quantity of money. Inflation determined entirely in labour markets. And the 2003 book said quite explicitly that you can account for inflation without any reference to the quantity of money. And by the way, to the extent that Woodford did follow money, he was following the monetary base, not broad money, not a quantity of money dominated by bank deposits. In fact, the Woodford book had no commercial banking system, no corporate sector, and no non-bank financial institutions. You can imagine my views about that, but I'll be coming out a bit more in the next few minutes. Now, these books and articles have been very influential, and I want now just to make two quotes from a speech given in Glasgow, in fact, by a lady called Silvana Tenreiro, a professor at the London School of Economics, who from 2017 to 2023 was an external member of the Bank of England's Monetary Policy Committee. So obviously not just influencing thought about monetary policy, but actually taking decisions on monetary policy. So a very important economist. And what she said in an April 2023 speech was that she wanted to make clearer the similarities between quantitative easing, central bank operations, that in her view were supposed to affect interest rates, but did affect the quantity of money, similarities between QE and bank rate, and avoid the impression, she wanted to avoid the impression that there is an independent money channel of QE operations. So QE doesn't work through money at all. And this, there's another part of this speech where she said quite clearly, QE affects the economy only to the extent that it affects interest rates. There is no separate money channel that can unleash inflation. To make clear that what she meant by interest rates here was both the central bank rate in England, in Britain, and also, of course, bond yields. So monetary policy is about bank rate, bond yields, and that's that. Okay. Now this is interest rate only macroeconomics at its most brazen and its most extreme. And over the years, I've been following this subject now for 40, 50 years. This is one of the most outlandish statements that I've ever heard emanating from the Bank of England. There's no independent money channel. Quantity of money doesn't matter at all in its own right. That's what Professor Tenreiro is claiming. I'm going to, in the next quarter of an hour, 20 minutes, criticize and condemn these statements. But I should just concede at the start that many people think in the same way as Professor Tenreiro, including, by the way, a chap called Ben Bernanke, who was chairman of the Federal Reserve during the Great Recession. And he brought out a book, which very recently, called 21st Century Monetary Policy. This was based, by the way, it was an expansion of things he had said in an article in the American Economic Review in 2020. And like Tenreiro, he wanted to translate QE operations back into interest rate terms so that it's, according to Bernanke, interest rates that are really measuring monetary policy and affecting the economy. Bernanke, by the way, has recently been made a Nobel laureate. Now, I don't agree with that either, but what I want to do quickly now is to explain how monetary policy can affect the quantity of money, regardless of interest rates, And then I'm going to talk a bit more about money and bond yields. Now, is monetary policy entirely about bank rate? Now, certainly not. Let's just think about a very simple set of operations. These are the operations behind QE. The central bank can have a deposit in the commercial banks like any other entity. This, by the way, isn't part of the quantity of money because the central bank's deposit doesn't affect its behavior. So what happens is when the Bank of England wants to carry out these operations, it goes to the clearing banks and it says to the clearing banks, perhaps other banks too, lend us some money, put it into our deposit, and we'll pay for that by adding to your cash reserves. These are a claim on us, the Bank of England. So this deposit for the Bank of England, where does it come from? It comes out of thin air. It's alchemy. There are similar additions to both sides of the clearing bank's balance sheet. The Bank of England then uses its deposit to buy something, anything, from the non-bank private sector, households, me, companies, pension funds, insurance companies, anything, usually backed, of course, government securities. And the effect of these purchases is to increase the deposits held by households, companies, pension funds, insurance companies. There is new money in the economy, and that is part of the quantity of money because it does affect my behavior, companies' behavior, pension funds' behavior, and so on. Now look, you get the punchline here. These operations can be conducted whether bank rate is 0, 10%, 50%, 100%. They are transactions that can occur regardless of the rate of interest, and historically that is what has happened. I was an analyst in the 1970s, 1980s, when often bank rate was in double digits. These operations occurred then, or the opposite of them, quantitative tightening if you wish. Okay. So you can think about monetary policy without thinking about bank rate. That's possible, clearly. And this is just childish. So, I'll come back to the Tenreiro statement. Monetary policy can be described without reference to interest rates. And that change in the quantity of money, as we're now going to see, can affect the economy regardless, again, of what's happening to bond yields. And in fact, the bond yield effect, as I'm about to explain, is really quite a trivial one. I'm going to use a very extreme example to show how trivial it can be, but what she's saying here is that these kind of operations affect the economy only if, when there are additions to the quantity of money, bond yields go down, or if there are sales of bonds by the Bank of England, which actually reduce the quantity of money, and bond yields go up. In saying this, of course, Tenreiro is echoing one argument in Keynes's general theory. It's an argument which goes into the textbooks, and I just put it here. I just want to thank the Economics Online website for using their little chart. But that chart appears in dozens and dozens of textbooks, including, in fact, a textbook. Samuelson's famous economics textbook first came out in 1948, which had 19 editions. Now, just be clear that I'm not disputing Keynes had this theory in his general theory, and his emphasis on it was very strong. So many economists thought that this was indeed the way in which the central bank monetary policy affected the economy. Hundreds of economists, thousands of economists think in this way. It was formalized by a chap called John Hicks in something called the IS function, which is one of the equations in three-equation New Keynesianism. All right. Now look, you'll gather from my tone of voice and the way I'm saying this that I don't have much time for this kind of stuff. Please, there is a very, very big problem. I've got some money in my bank account. With that, I can do all sorts of things. You know, I buy some more furniture, I can go to the supermarket and buy some food. Or I can buy some equities, or I can buy a house, or invest more in a house. I don't have to buy a bond. This idea that the only way in which the monetary operations affect the economy is through the effect on bond yields is utterly false. Portfolio choice is not only a choice between money and bonds, it's a choice between many things, part of them being in the what economists call the income, output, expenditure, circular flow. But also, of course, there are other assets from bonds, and crucially, there are corporate equity and there's houses. The point about equity and property is that the income varies, unlike bonds where there's a fixed interest payment usually each year. These kind of assets are much more important in a capitalist economy, much more typical, and as far as, now I'm going to give an example, as far as American households are concerned, they're far, far more important. At the end of 2021, American household wealth was about getting off $170 trillion. Personal income was $18, $19 trillion. National income getting up to $25 trillion. And how large were households' holdings of bonds? They were under $3 trillion. And these, by the way, would have been only very wealthy households normally. Most households don't hold bonds at all. They're not making a choice between money and bonds. Let's then think about the COVID period. One of the things that I did in this period was to highlight the explosion in US money in spring and summer of 2020. So the quantity of US broad money went up by almost 20% in the 5 months to July 2020. There's greater volatility in money held in the financial sector than in the financial sector. So the money held in the financial sector in this period would have risen by 30, 40, 50%. I'm not making that up. Now look, if you're a financial institution and you keep a stable ratio of your money balances, your cash so-called, to your assets, and suddenly the money's gone up by 30, 40, 50%, you're supposed to have a stable ratio like all the competitors. What happens to share prices? They soar. Rich people own some stocks and shares. Gosh, suddenly so much richer. Let's buy a house. House prices go up too. So, let's just look now. These are all, by the way, data from the Federal Reserve. I wish sometimes the top people there would look at the information they themselves produce. This shows you, quarter by quarter, through the COVID period, the changes in the value of real estate, houses most. This is all held by the personal sector, household sector. Real estate, houses mostly. There's then directly held shares. There's then mutual fund shares. And then there's also the assets owned in unquoted companies like, say, the equity in legal partnerships or small stores, whatever it might be, farms. These variable income assets. What I've done here in the final column is to add up the changes in the value of these assets through those quarters of the COVID period when the inflation process was building up. So in the first quarter of 2020, there was a big drop in the value of these assets, not surprising because of worries about COVID. And then the next 8 quarters, because of that, it was caused by excess money growth, please, you had a jump in the value of these assets of almost $32 trillion, which was larger than American households' personal income in 1 year. What happened to the economy? It boomed. And what happened to the prices in the shops and websites and so on? They went up strongly. That was what caused American inflation in this period. Now look, I've just been through all of this, and it's changing the quantity of money, affecting the prices of stocks and shares, then affecting the economy. It's got nothing to do with bond yields, nothing to do with interest rates. Let's look now at the price of what I've just shown you, this surge in the value of equity and housed in the critical period. Look at the change in the value of debt securities, because that data also is produced by the Federal Reserve. You can see there are some quarters in the second half of 2020 when the change in the value of variable income assets was over 1,000 times that in the value of debt securities, bond yields, interest rates. Please, Professor Tenrero, what are you talking about? Look, this is nonsense. The explanation for the boom in asset prices in that period, and then for the wider boom in the economy, and then for the increase in inflation, was the jump in money growth. And I explained this, and indeed explained the quantification of the projection in my special emails from the Institute in March and April 2020, using a broad money framework, which is simply an example of the quantity theory of money. All through the 21st century, we've had these new Keynesians talking about how what they're doing is scientific. Their claims to the scientific status, and then of course with Bernanke's, the title of his book, claim to modernity too, the 21st century monetary policy. I would ask you to be very skeptical about this kind of thing. Obviously, what I've done in the last few years, and then more particularly in this short book, is to argue that there is a relationship between the quantity of money and nominal national income, and that accelerations in money growth will lead to accelerations in inflation. I just want to reiterate that message now. I also, by the way, in this short book, I'm pretty scathing about this IS function, one of the three equations in New Keynesianism. This has been a humiliating episode for modern economics. And I'm not the only person to say that, because in this book I do quote a chap called Jason Furman, who's one of the economic advisors to President Obama. He complained about the collective failure, dismal performance of economics. Yes, Professor Furman, absolutely right. And let's understand why it occurred. It occurred because some economists in the last 20, 30 years have bamboozled themselves into believing something called interest rate only macroeconomics. That kind of macroeconomics is utterly wrong. Thank you.